Hello, good morning to all and happy Friday. This is Kelvin here again. Welcome to today's Daily Dose of Market Insights. Good morning and happy Friday. Today will be the 17th of January 2025. So before we kickstart today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future and likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the gist of the daily dose, which is the intraday technical outlook on the broad-based cross-asset classes, let's have a quick recap what has taken shape yesterday in terms of the news flow, relevant news flow release, economic data, as well as the intraday performance on the broad-based cross-asset classes yesterday. So let us start with economic data release first. All right, so yesterday we do have two economic data release, which is pertaining to the UK economy and the US economy. So let's take a look at the UK economy first. So UK economy it's more like a tier 2 data, kind of more lagging. It's due to the GDP month-on-month figure, which is the monthly GDP figure for November. So it actually came in below expectation of 0.1%. Markets expecting only a higher 0.2% month-on-month, but with this lesser lackluster GDP reading on a monthly basis, month-on-month basis for the month of November, that actually implies that the Bank of England will have more evidence to remain more dovish going forward in 2025. So that actually also explained to us the lackluster performance of the sterling against the dollar yesterday, still remaining below the resistance level that we highlighted in our intraday technical outlook for yesterday daily dose. I'll touch more about that later when I cover the intraday technical segment on the major dollar pair. And also over in US, we do have the release of another key, this tier 1 data, because retail sales, because why retail sales constitute in is part of the services activity in the US that contribute close to 3/4 of US GDP growth. So if you look at retail sales on a month-on-month basis, it actually came in below expectation. Markets expecting 0.6% month-on-month, it only came in 2 basis points lower at 0.4% month-on-month for the month of December. So that being said, yes, we have a softer retail sales number, but that also doesn't really change much the market expectation on what the Fed is about to do in this upcoming FOMC meeting at the end of January this month. How do we know that? By looking at the CME Fed Watch tool, where CME managed to actually compile according their own data analytics by taking into account of the latest pricing of the Fed Funds futures market over here. So based on Fed Funds futures market participant, high chance that they still expect the Fed to stand pat on 29th of January 2025. So that is actually the first day of the Chinese Lunar New Year, to maintain the Fed funds rate at 4.25% to 4.5%. So despite the rather slightly softer retail sales figure yesterday, it doesn't really change much the doubt, because before the retail sales release, the US retail sales release yesterday, market is expecting 97.9% to remain unchanged for the Fed funds to maintain the interest rate at 4.25% to 4.5%, 97.3%, almost unchanged over here. And what's interesting over here is you look at the aggregated probability. So based on the aggregated probability, market also expecting on the 19th of March, which is the next FOMC meeting after 29th of January, also high chance to maintain it at 4.25%. Why? By looking at a probability of 67%, which is more than 50%. And the next interest rate cut will be expecting in either June, 18th of June or 30th of July this year, which has markets assigned a high chance so far, 98% and 85% chance. So potentially there could be still one interest rate cut before 2025 ends. And right now, market has started to assign a high probability of 10th of December 2025 FOMC meeting for the second cut to come in on before the year ends this year, on 10th of December FOMC meeting. So that has a higher chance of rather high chance of 68%, because is clearly above 50% chance. So if you look at the market pricing right now, it's still within the US Federal Reserve latest dot plot projection, where if you could recall, based on the last FOMC meeting in December last year, the US Federal Reserve kind of penciled in a projected 2 interest rate cut this year for 2025. So that is still within market current pricing based on the CME Fed Watch 2. So net overall, right, that also represents a rather normalization pivot policy, which I reckon that should take place by the Fed in 2025 this year. Much more less dovish monetary policy stance by the US Federal Reserve, and that could also potentially see the dollar strength remains its footing from a longer term, medium term perspective. All right, and if you look at the FX market yesterday, what we could see on here is that the dollar just traded sideways, but the dollar remains weak against the Japanese yen. So those who follow our daily dose of market insights since the start of this week, on the short-term intraday technical basis, we do highlight that we do have an interim top of resistance at the 15880 level. And since the start of this week, or since late last week, the dollar yen can't break above this level and plummet below it, below 156 figure, below 157 figure, and continue to inch low as since 2 days ago. All right, so the reason why the dollar yen is remains weak, because market is now assigning a high chance that the Bank of Japan, when they conclude their monetary policy on next Friday, so next Friday will be a key date for dollar yen, which is on the let me have a quick look, calendar 24th of January. So we'll talk more about that in next week daily dose. So on the 24th of January, which where the Bank of Japan conclude its monetary policy meeting, there's now a high chance that Bank of Japan may starts to hike interest rate. All right, or I would say normalized interest rate based on the rather lukewarm hawkish guidance given by BOJ Governor Uda and his Deputy Governor Humino these 2 weeks. So that should explain why the short-term persistence minor downtrend that is on in place right now for the dollar yen. All right. So now going forward, let's look at the US stock market. So the US stock market actually rather lackluster. So those who follow our daily dose yesterday, we flipped to bearish bias on the Nasdaq 100, which actually turns out as expected, where the Nasdaq actually performed the worst among the major US stock indices yesterday, down negative 0.69%. The Dow Jones down slightly lower at negative 0.16% due to the rosy performance of key major financial stocks, where Morgan Stanley managed to beat profit expectation. And bear in mind that it has a feedback loop into the Dow Jones Industrial Average. Why? Because the Dow Jones Industrial Average has a higher weightage on Goldman Sachs versus the mega cap technology stocks. Okay, so that explains why the Dow Jones didn't fall as much as the Nasdaq 100 and the S&P 500, which is down by negative 0.21%. The outperformer yesterday was the Russell 2000, up slightly by 0.15%. And one of the reasons why the Dow Jones one of the reasons why the Nasdaq 100 performed badly as expected yesterday was due to this negative news flow pertaining to that rather ongoing frosty relationship between US and China as they battle out in this high-tech war that is still ongoing. And yesterday there was a news flow that report China begins probe into US chip grants and a large dumping. So Beijing is investigating after local firms protest subsidies. This probe coincides with tit for tat US-China chips conflict, and this potential, we call it a two-way tit for tat situation, will continue to play out, especially with the incoming Trump administration on next Monday. All right, and also yesterday there was actually where is this? Give me a minute. Let me find that particular news flow. Yeah, this is the one. So yesterday there was this hearing from Senate hearing on the appointees of Trump key officials or secretaries. So yesterday was an important one where the Senate grilled the the what you call it, the Treasury nominee, Mr. Bissent. So Mr. Bissent, he actually sounded rather we call it hawkish towards China relationship, because indirectly he did saying that US must secure supply chain and protect the dollar. So secure supply chain means secure semiconductor supply chain. All right, so this is based on his testimony given to the Senate panel yesterday. All right, so that also kind of create a negative feedback loop into the Nasdaq 100. Why? Because it consists of the key mega cap stocks that has indirect or direct, we call it a business interest on the global semiconductor supply chain, and with that, that could start to see more tick for tat measures between US and China going forward. All right, and another news flow and share with you all is more pertaining to the Chinese economy. So the Chinese economy released their key tier one data today. Yes, the housing price index continued to show signs of a deflationary spiral, but it's kind of came in, the rate of declines tend to slow down slightly at negative 5.3% year on year for December, better than the previous month of negative 5.7%. And what's interesting over here is that the recent stimulus managed to boost Q4 quarterly growth or GDP figure, annualized rate at 5.4% year on year, way better than what market is expecting at 5%. And industrial production also beat market expectation, way above at 5.4%, came in at 6.2% and above 5.4% in November. Consumer spending, retail sales also improved 3.7%, above 3% previously in November, and managed to beat slightly expectation at 3.5%. So net, this slew of, we call it positive results or positive tier one economic data from industrial production and retail sales, and as well as Q4 GDP growth, seems to be implying that the current stimulus, we call it measures, has starts to slowly trickle down into the real Chinese economy, and that also start to see rather rosy performance today on the China, we call it HSCEI stocks as well, managed to actually gain slightly, and the Hang Seng Tech managed to improve by 0.26%, but not really that rosy at this moment in time. So later I'll share with you what are the key levels to watch on the Hang Seng Index, which is the Hong Kong 33. All right, over here, not that rosy, but also not that bad. It didn't actually crash. Instead, I mean, it didn't fall by 1% or more. So later I'll touch on more on the Hong Kong 33 index, which represent the Hang Seng index when I cover the intraday technical outlook segment. All right, so with that, that's actually the key news flow, and as well as the intraday performance of the broad-based cross asset classes. All right, so before we go, let me test my screen now. So I think you guys should be able to see the screen and hear me clearly. Let me do a test. Okay, I think everything should be good. So with that, let me now expand my screen so that you guys could have a better view on the chart. Yeah. All right, good. I think this should be the screen that's being expanded. So now with that, let me start with the FX market first. So we know that FX market, most of the dollar major pair go sideways yesterday. So that's also very much in line with our expectation. The euro dollar continues to trade sideways. Can't break below the first support level that we highlighted yesterday at 1.0240, but still remains below the downward sloping 20-day moving average. So which is at the first resistance at 1.0330. So with that, I'll be still using a slightly higher short-term pivotal resistance level since it can't break below the 1.024 support level. I don't target it so much to prevent any whipsaw. So still using 1.0375 for today. Short-term pivotal resistance on the euro dollar, maintaining its intraday trend bearish bias. For sure, first support level, it got to break below it will be 1.024. Only a break below 1.0240 will revisit this Monday minor swing low area at 1.019, which is 1.019. Only an hourly close above 1.0375 will invalidate today's intraday trend bearish bias to see the extension of a potential minor mean reversion rebound taking shape to expose the next near-term resistance zone at 1.0440, 1.0460, which is the minor swing high area of 20th of December and 30th of December, and as well as confluencing with the downward sloping 50-day moving average as well. So net overall, still maintaining that intraday trend bearish bias on the euro dollar using 1.0375 as my short-term pivotal resistance level. But in order for the bears to gain more traction, it got to surpass, or it got to break below the first intraday support level at 1.0240. Moving on, next will be the sterling dollar. So the sterling dollar also continues to actually hover above the below the short term, below our first resistance level at 1.2560 level, but it also can't break below the first support that we highlighted yesterday, which is at the 1.2160. Okay, 1.2160 over here. Despite a rather lackluster month-on-month November GDP number that was released, all right, over here, then just push up during the US session and traded sideways. So since it can't break below the 1.2160 first intraday short-term support that we highlighted yesterday, we do not want to tighten the short-term pivotal resistance to be so tight at 1.2260. Still use 1.2325 as my short-term pivotal resistance level to maintain that intraday bearish bias on the sterling dollar. 1.2160 got to break down in order to the bears to gain more footing to actually kind of expose the next near-term support level at 1.2080. Only an hourly close above 1.2325 will invalidate today's intraday bearish bias to see a squeeze up or the start of a potential mean reversion rebound, exposing the next near-term resistance at 1.2375/1.2405, which correspond to the downward 20-day moving average. Correspond to the downward 20-day moving average. A breakout above it sees 1.2480, which is correspond to also the upper limit of the medium-term descending channel that I drew from the high, or it has been in place since the high of 27th of September last year. All right, over here, let me go back to the chart again. Okay, so net overall, I'll be still using 1.2325 as my short-term pivotal resistance level to maintain that intraday trend bearish bias on the sterling dollar. Only a break below the first intraday support level at 1.2160 in allow the bears to gain more bearish footing, exposing the 120.80 next near-term support level. All right. Now moving on will be our Asia Pacific major dollar pair, starting the Aussie dollar. So the Aussie dollar continues to churn within the neutrality zone below 62.50 and 62 figure. Yesterday during the US session, during the start of the US session, it attempted to break below it, but didn't have a clear hourly close below it, and it traded sideways. And also given today's rather rosy China key data as well, it also managed to hold above the 62 figure level so far. So with that, it's coming to Friday. So really, given that today's there's not much data released as well during the US session, the European session, which I'm going to share with you all later. So still maintain that neutrality stands between 62.50 and 62 figure level. Unless we have an hourly close below 62 figure level, then that I could validate a potential trend bearish bias on the Aussie dollar, potentially visiting the next near-term intraday support level next at 61.65, followed by 61.20 level. So net overall, for today, we'll still maintain that neutrality stance between 62.50 and 62 figure level, and continue to watch the lower limit at the 62 figure level for today on the Aussie dollar. Now, turning our attention will be the dollar yen. So the dollar yen continues to actually trade lower, according to see a series of lower low yesterday. So printed a lower low today at intraday low at 154.98 in today's Asia session over here, today's Asia session, before staging a minor bounce. So with that, I will have a slightly tighter short-term pivotal resistance for today at 156.30, which also correspond to this congestion area over here very clearly. Former minor swing low broken down, turns into a pullback resistance that got rejected on Thursday, which is Thursday, yesterday's start of the US session before plunging lower. So using the Titan key short-term pivotal resistance level at 156.30, we'll continue to maintain that intraday trend bearish bias on the dollar yen. Today's intraday support level to watch will be 154.30/15, only a breakdown below 154.15. exposes the next near-term support level at 15320, which will correspond to the 20-day moving average and as well as the minor swing low of 18th of December. Only a push out with an hourly close above 15630 will invalidate today's intraday trend bearish bias to see a squeeze up for a mean reversion rebound scenario to retest the 20-day moving average that is now acting as a graphical resistance as well, or confluencing with a graphical resistance as well at 156 or 15715. And if you look at the 15715, taking into account of this ongoing minor decline from the high of 15th of January, which is Wednesday, all the way down to today's Friday, 17th of January intraday low, is correspond to the golden ratio closely at 61.8% as well. All right, so net overall, using a tightened short-term pivotal resistance for today for the dollar yen at 15630 to maintain our intraday trend bearish bias. Now, let's sum up the intraday technical outlook on the major dollar pair. So now turning our attention now will be the major stock indices, starting with the Hong Kong 33 or the Hang Seng Index. So I could see over here the Hang Seng Index now managed to attempt to break the descending channel resistance, this dotted red line here, the minor descending channel resistance from the high of 10th of December. Okay, it tends to break out above it, but a bit of hesitance at the 20-day moving average at this juncture. But if you look at the daily, the hourly RSI, it seems to be turning bullish as well, as you managed to actually stage a bounce right above this former swing high here, former resistance, parallel resistance, now turns into a pullback support, and this bounce also takes shape right above the 50 level mark over here. Right above the 50 level mark, indicating some form of short-term bullish momentum has starts to creep back into the Hong Kong 33 based on the observation on the hourly RSI, which is a momentum indicator. So with that, I'll be using, because yesterday we have a neutrality stance. We do have a neutrality stance yesterday. So flipping from a neutrality stance to a rather short-term intraday bullish stance on the Hong Kong 33 for today, using 19,285 as my short-term pivotal support level. First resistance it got to surpass will be 19,580. A clear hourly close above it exposes the next resistance level to watch out for will be at 20,140, which is the minor swing high area of 24th of December and 6th of January that got rejected earlier on at the start of this year. Only an hourly close below 19,285 will invalidate today's intraday bullish bias to expose the next near-term support level at 19,125. Below it sees the minor swing low of this week, which is 13th of January at 18,750, which will correspond to the key long-term moving average, 200-day moving average over here. So net, given the rather positive elements that is being seen on the hourly RSI, we will flip to a intraday trend bullish bias on the Hong Kong 33 using 19,285 as my short-term pivotal resistance. First resistance you got to surpass for sure if your hourly close above it. 19,580 will gain more credence to the bullish intraday bullish bias. Okay, so that's for the Hong Kong 33. Turning our attention will be the Japan 225 or the Nikkei 225. So the Nikkei 225 plummeted as expected and hit our first support level at 38,140. So with that, we will have a tightened short-term pivotal resistance for today at 38,655, which is correspond to the 200-day moving average as well. If you will do the Fibo retracement of this current sell-off from the high of Thursday all the way down to today's intraday session low, that correspond to the 76.4 Fibo retracement. All right, so as long as any potential chance of a pullback didn't surpass 38,655, we will still maintain that intraday bearish bias within this medium-term sideways range configuration of the Japan 225. Next near-term support level to look up for will be at 37,990, followed by 37,700 on the intraday basis, which is the minor swing low of 19th of November and 28th of November. So as a quick recap for those who are new to the Nikkei 225, since 27th of September last year, it continues to be trapped in this kind of multi-month or medium-term sideways range configuration. And right now, potentially, we are seeing it floating down towards the lower limit of this medium-term sideways range configuration on an intraday basis. So net overall, using a tightened key short-term pivotal resistance for today at 38,655 on the Nikkei 225, i.e. the Japan 225, to maintain this ongoing intraday bearish bias within its medium-term sideways range configuration. Only an hourly close today above 38,655 will invalidate today's intraday bearish bias to see a squeeze up towards the next near-term resistance level to watch will be 38,960, followed by 39,180, which confluence with the 20-day and the 50-day moving average, acting as a similar resistance level as well. So that's for the Japan 225. Turning our attention will be the German 30 or the German DAX. So the German 30 and German DAX continues to actually drift higher yesterday, playing around with the upper limit of our neutrality zone around the 20,700 mark level. So still recall that we do have we call a neutrality stance yesterday for the German 30, and the German 30 seems to be now starts to evolve in the minor ascending channel from the low of 30th of January, okay, which is this Monday. So with that, potentially there may be some form of minor pullback at the start of the European session towards the lower limit of this minor ascending channel. So I'll create a zone here because it also correspond below it the minor swing high area of 20,570, 20,490. That was the previous all-time high previously that was formed on 13th of December. So using a zone, a short-term pivotal zone of 20,570, 20,490. So as long as this minor pullback that may take shape during the European session didn't surpass below 20,490 lower limit of this short-term pivotal support zone, we will flip to a intraday trend bullish bias on the German 30. Next resistance level to watch will be 20,845/20,905 next, which correspond to the upper limit of this minor ascending channel and as well as a Fibo extension cluster level as well. Only an hourly close and a breakdown below 20,490 will invalidate today's intraday trend bullish bias on the German 30 to see a minor corrective decline, exposing the next near-term support level at 20,330. Below it sees 20,190, which correspond also to the 20-day moving average. So net overall, flipping to a intraday trend bullish bias in any chance of a potential minor pullback during the start of the European session, using 20,570/20,490 as my short-term pivotal support level on the German 30. Now, focusing our attention now will be the major US stock indices, starting with the Dow Jones Industrial Average, which is represented by the US Wall Street 30 in our platform. So the US Wall Street 30 actually continues rally, almost hit our first resistance level at 43,670 level, and the hourly RSI also starts to shape a bearish breakdown as well. Okay, there was a bearish breakdown here on the parallel support. Okay, the former parallel support over here, breakdown, tested, come break, and shape a series of lower high. Okay, so with this bearish observation on the hourly RSI, I will have a tighten short-term pivotal resistance level for today, switching from 43,730 to 43,460. Right, let me put it in writing for you guys to see. 43,470. All right, over here. Okay, so using a Titan key short-term pivotal resistance for today. Why? Because of that current bearish bidding that is being depicted by the hourly RSI. 43,470, Titan short-term pivotal resistance to maintain that intraday bearish bias on the US Wall Street 30. First support level to watch out for today will be 42,660, which correspond to the 20-day moving average as well. Only a breakdown below 42,660 will potentially gain more credence for the bears to extend the weakness towards 42,220 next, 42,200 next. Only an hourly close above 43,470 will invalidate today's intraday bearish bias to see a squeeze up towards 43,730. Above it potentially sees 44,195, which is the minor congestion area over here of 10th of December and 12th of December, and as well as the pullback support, pullback resistance level of the former minor ascending channel support from the low of 5th of August. All right, so net overall, we will use a slightly tightened short-term pivotal resistance for today at 43,470 to maintain our intraday bearish bias on the US Wall Street 30. Now, turning our attention will be the Nasdaq 100. So the Nasdaq 100 tested our short-term pivotal resistance and plunges down as expected. Over here, the hourly RSI also broke down below a parallel key short-term support level as well. Hasn't hit the oversold region yet, but it hasn't broke below our first support level at 20,990. So still no change. We'll be using 21,370. A bit of excess yesterday because there was a prop over here. Okay, 425. So give a bit of excess at 425. 425. So 21,370 excess 425 short-term pivotal resistance level on the Nasdaq 100 to maintain that intraday trend bearish bias, and also close so far price action also got rejected at the 50-day and the 20-day moving average yesterday. Another credence of potential bearish pressure has started to research on the Nasdaq 100 despite that earlier pop-up on that CPI data release, and also that pop-up was almost get erased by yesterday as well. So as long as the first support level is not surpassed on the downside for today at 20,990, we'll still be using the same pivotal resistance level, except we have access at 425 to 1,370/425 short-term pivotal resistance level. Only a breakdown below 20,990 with an hourly close below it potentially allows the bears to gain more footing to expose the next near-term support level for today on the intraday basis at 20,700 next. Only an hourly close above 21,425 will invalidate today's intraday bearish bias on the Nasdaq 100 to see a squeeze up to retest 21,730 in the first step, which is the minor swing high area of 7 on Jan and confluencing with the former minor congestion area of 26th of Jan and 26th of December and 27th of December as well. So net overall still maintain that intraday bearish bias using 21,370/425, which is the excess yesterday, as our short-term pivotal resistance zone. All right, so that sum up the intraday technical outlook on the major stock indices. So with that, now let us turn our attention to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, yesterday we do have a neutrality stance, and price action squeeze up and hit and test the upper limit of that neutrality stance. So this neutrality stance is important. Why? Because it's the upper limit of this potential ongoing minor ascending channel range resistance. Okay, it hit yesterday at 2,716, 2,728. So with that, this is considered as our medium-term pivotal resistance zone. So upper limit is 2,728. So as long as 2,728 medium-term pivotal resistance zone is not surpassed to the upside, we will now flip to a intraday trend bearish bias. Why? Because if you look at the RSI, it also starts to break down from a support level as well. Okay, after and so exit from the overbought zone. So with that, using 27,016 upper limit, 27,728 pivotal resistance for today. First support level to watch out for will be 2,700. Only a breakdown below 2,700 potentially expose the next near-term support for today at 2,677, which is the minor swing low of 15th of January, and as well as the lower limit of this ongoing minor ascending channel support that is in place since 31st of December. Only a push up with hourly close above 2,728 will invalidate today's bearish bias on gold XAU/USD to potentially kickstart another round of impulsive up move sequence. In first step, exposing the next resistance level at 2,748, followed by 2,772 next. So that's for gold XAU/USD, since it's at the top of this potential minor ascending triangle range resistance, coupled with a bearish reading that is being seen on the hourly RSI. We'll be using 2,716 upper limit 2,728 as our pivotal resistance for today, and flip back to a intraday bearish bias for gold XAU/USD. Now, lastly will be the West Texas crude oil. So the West Texas crude oil yesterday tested our short-term pivotal support level and staged a bounce over here. So there's a bit of excess over here. Okay. Okay, give me a minute. Okay, at 78.25, the low here. Let me put it in writing. 78.24. All right, a bit of excess. 79.10 excess 78.24. So you're still using this as my short-term pivotal support level. Still maintain that intraday trend bullish bias. And also you look at the RSI. The RSI also managed to bounce off from a support level as well. now able to actually break above the 50 level mark, indicating some form of intraday bullish momentum has started to resurface for West Texas Oil. So using 7910/7824 short-term pivotal support zone, maintain that intraday trend bullish bias. First resistance to watch for today, 80.90, and hourly close above it exposes the next near-term resistance zone of 8330/8380 level, Fibo extension of 1.236, and as well as the minor swing high area of 12th of July and 18th of July last year. Only hourly close below this 7824 will invalidate today's intraday trend bullish bias to revisit 7756 followed by 7670, which is the dotted green line here. So what is dotted green line? 7670 is in fact the former former major descending channel bullish breakout taking from the high of 28th of September 2023. So that level is at 7770 next. All right. So with that, that also sum up the intraday technical 7670. Yeah. So that's also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today, during the start of the European session at 3 p.m., we have key tier 1 UK data, which is retail sales for December. Year-on-year market is expecting a strong recovery of 4.2%. That's rather optimistic. We'll see how it goes over here, because that could actually impact the movement of the sterling dollar. So that's out at 3 p.m. Singapore time. And we have the finalized Eurozone inflation rate. That shouldn't be a big surprise because the flash figure was released 2 weeks ago, out at 6 p.m. Singapore time for the month of December. And thereafter, we have some housing data from US housing stats out at 9:30 p.m. Singapore time. And during the after that, during the early Asia later part of the US session will be a rather quiet session. So with that, that actually also sum up today's daily dose of market insights. So I'm Kelvin here signing off. I wish you guys a great, wonderful and restful weekend, and we shall speak again on next Monday. Thank you so much.